LMI, yes or no? Lender's mortgage insurance is the most debated concept when it comes to buying your first property, which stands for LMI, Lender's Mortgage Insurance. Now, when considering it, you might say, well, do I save a bigger deposit or do I go in now because I want to catch the ride on the market? So it's a pretty important question to consider. Now, if you are looking to get in early, what are the pros and cons? Well, number one is leverage. The pro of that is you're buying a property with less of your own money and more of the bank's. So that allows you to have a bigger return on investment should the market take off, because you've bought that same asset, but with this much money instead of more. That's a big pro. The other pro is timing. You can get in today or maybe tomorrow, but if you were asked to save double the deposit to avoid lender's mortgage insurance, suddenly you might have a $60K deposit for a $500,000 property or a $400,000 property, and that might turn into now needing $120,000 or $100,000 plus for the same property to avoid it. Savings is not easy, and it does take a lot of time. So imagine how much time in the market you miss out just because you didn't get in there with lender's mortgage insurance. But then comes the cons. If you're considering the cons, what are the cons around LMI? Now, number one is to pay for something to get early access. So it's almost like you're getting this VIP membership to this club. Well, it's the same as you're getting early access to this property, so we're going to charge you this little bit extra. Now, why is this charge happening? Well, the banks actually want to be covered in the case that values change, you default or can't make payments, and you have to get rid of the property at a loss. And because of that risk that becomes higher, considering you're borrowing more for something, there's less gap in the values, the bank says, hey insurer, how much is it going to charge for us to give this person the property at this price? Let's just say a $500,000 property, it might be 6 to 8K for lender's mortgage insurance. So the bank will then get that money and say, hey Mr. or Mrs. Customer, can you please pay this charge now because we're giving you this loan early? And that loan will incorporate lender's mortgage insurance in it. So that just simply means that you're now going to have an extra payment or an extra cost when buying the property. But if you did have a $6,000 to $8,000 or even $10,000 lender's mortgage insurance, that little bit of growth in the property could technically outweigh it. Now, if you're talking a $500,000 property, 10% growth, it could be a couple of years that it takes to get to that. That's $50,000. Does that $10,000 really mean that much then? But at the same time, you don't want to be over leveraging yourself because a small shock could put you out of balance. What do those small shocks look like? If you've got a higher loan amount compared to the property value, if property values change, you could feel uncomfortable with your wealth position. And secondly, if interest rates rise, you lose a job, or if expenses come up that were unexpected, suddenly if you don't have the right buffers, because you've got a more costly loan in place due to the higher loan amount, suddenly you're not going to be in a good position with your finances. So the key is to understand it is a tool in your favor to get you access to property sooner, to grow a portfolio sooner, and for you to have a greater ROI, return on investment, in case the property values grow. But on the flip side, it's important that you might need to save a little bit extra for that cost. You will have a cost in the second part. And lastly, there is higher risk because of a higher loan to the value. Hope that helps you understand more about LMI, lender's mortgage insurance. That's it from us here at InvestorKit, the experts in wealth creation, helping you take action.